U.S. Federal Reserve raises largest interest rates to combat inflation. The Fed raised its main interest rate by 0.75% to combat excessive inflation, its biggest increase in over 30 years. The Fed's recent action will boost its benchmark short-term rate to 1.5% to 1.75%, affecting many consumer and commercial loans. Policymakers forecast its benchmark rate to reach 3.25 to 3.5% by year's end, the highest level since 2008, making most kinds of borrowing more costly. Inflation has hit a 4-decade high of 8.6% and shows little sign of receding, so the central bank is tightening lending and slowing GDP. Americans now anticipate rising inflation to persist longer. This mood might instill an inflationary mindset in the economy, making it tougher to get inflation down to 2%. The Fed's 3/4-point rate rise surpasses the half-point raise Chair Jerome Powell had predicted this week. The Fed's decision to raise rates so much on Wednesday was an admission that it is struggling to manage inflation, which has been exacerbated by Russia's conflict against Ukraine and its repercussions on oil prices. When asked why the Fed announced a more aggressive rate rise than he had before signaled, Powell said inflation was higher than projected. Inflation has become a top voter worry in the months before the midterm elections, dimming the public's perception of the economy, lowering President Joe Biden's popularity ratings, and increasing the chance of Democratic losses in November. Mr. Biden has tried to demonstrate he understands the suffering inflation is giving American families, but he has failed to identify legislative solutions. The president believes the Fed controls inflation. Rate rises are weak weapons for lowering inflation and supporting growth. Oil, gas, and food shortages drive inflation. The Fed is not well suited to handle several of the causes of inflation, including Russia's invasion of Ukraine, congested global supply chains, labor shortages, and soaring demand for plane tickets and restaurant meals. As a direct result of the Federal Reserve's actions, the cost of borrowing money has already skyrocketed across a significant portion of the U.S. economy. For example, the average rate on a 30-year fixed mortgage has surpassed 6%, which is its highest level since before the financial crisis of 2008. This rate was just 3% at the beginning of the year.